Hi, today what I wanted to do is talk a little bit about mortgage insurance. What is it? And then maybe even more importantly, how do you get rid of it? And so many of you already probably know that mortgage insurance is required when you're buying a home, taking on a mortgage, and you're doing less than 20% down. However, what some of you may or may not know is that mortgage insurance is strictly there to protect the lender. It's only to benefit the lender. It does not benefit you, the buyer, in any way. And the reason being, if you're doing less than 20% down, the mortgage insurance is required because if you, as the buyer, default on the loan, stop making your payments, and now the lender has to come and foreclose on the property, they then will have their costs involved with the foreclosure. They're going to try and sell the property for as much as they can, but in the event that there is any kind of a shortfall, a shortcoming between what they're able to sell it for and what is actually owed, that difference is made up with the mortgage insurance. So the mortgage insurance then satisfies that difference. Now, conventional and FHA both approach this slightly differently. So I'll go into those differences and we'll start with conventional. On the conventional side, what they do, first of all, is they look at your credit score, your down payment, are there multiple buyers on the loan, things of that nature. Factor that all in, take all those risk factors into account, and then they'll come up with either a monthly factor or a lump sum factor that we then utilize to calculate what your mortgage insurance is going to be. The most typical kind is a monthly, where let's just say, for example, it's a 0.4% factor. And so what we would do is we would take your loan amount times 0.4% divided by 12, and that's the amount of the monthly mortgage insurance we're going to collect. However, conventional also offers a lump sum, or like a mortgage insurance buyout, where you can just pay a flat percentage right up front and then not have it part of your monthly payment. You can then either pay that in a lump sum at closing, or if you've done at least 10% down, you can oftentimes finance that in and add it into your loan amount. That's another way you can go about it. And so that on the conventional side is referred to as PMI, or private mortgage insurance. And that's how that works from that perspective. Now, on the flip side, FHA has what they call mortgage insurance premiums, or MIP. They have two when it comes to the purchase. They have what's called your upfront mortgage insurance premium, and that currently is 1.75%. We take that 1.75% times the loan amount, and then that gets added to your loan and financed in, so you don't have to pay that out of pocket. They also then have a monthly mortgage insurance that is either 0.55% or 0.50%, depending upon whether you're doing the minimum down, which is 3.5%, or if you're doing 5% or more down. 3.5% minimum down, it's 0.55%. And just like conventional, we take your loan amount times 0.55% divided by 12, and that's the amount that we collect every month. If you do 5% or greater down in an FHA loan, then it's 0.50% times your loan amount divided by 12, and that's the amount that we collect every month. So that's basically the differences as far as how they calculate them and how it gets factored in. Now let's talk about how do you get rid of the mortgage insurance, okay? On conventional, there are three different ways you can get rid of it. The first way is that it will automatically come off your loan once your loan amount hits 78% of your original purchase price, or appraised value, whichever is less. Now, that's on the original. So in other words, just for simple math, if you bought a home at $100,000, you put 5% down, so you borrowed $95,000, and now you've been making the payment for several years, and you've got your balance paid all the way down to $78,000. Once that balance hits $78,000 against your original purchase price of $100,000, you're in a 78% loan to value. When you hit that 78%, then it automatically comes off. What is probably a little bit more common is where you're taking into account your appreciation on the home. And at that point, you only have to get to an 80% loan to value. So using that example, what would happen is, let's just say between you making your payments and you paying down the loan, now all of a sudden you've got 20% equity in there because the home is worth more and you've paid down. You then request from your servicer to remove the mortgage insurance. They will likely have to have you get an appraisal done to show that you've got that equity. But once you get the appraisal done, once you go through that process, they'll then remove your monthly mortgage insurance. And so it could almost serve as a mini refinance, because let's just say you've been paying $150 a month for mortgage insurance. Once you have at least 20% equity, you reach out to the lender and they agree to remove it. That just comes off your payment, so that just lowers your payment now by $150 a month. And then the third way, which is also somewhat common, is just refinancing the loan. Now, the only reason you would want to likely refinance is not only do you have the 20% equity, but you have an ability to get a lower interest rate. Or maybe you want to shorten up the term and go to 15 years or something like that. That's where you would want to look at potentially refinancing. If your rate is essentially the same as to what you could get on a refinance, that's where you would probably want to take that second option of just getting an appraisal done, requesting to get the MI removed, because you're not really going to be able to save much as far as the actual interest rate. Now, FHA, the difference there is quite huge actually, because with an FHA loan, what happens is that monthly mortgage insurance stays on there for the life of the loan. The only exception to that is if you took out an FHA loan and you put down 10% up front, it will automatically come off, but after 11 years. There is no opportunity to have you provide an appraisal showing you've got 20% equity to get it removed. FHA, it'll stay on there the life of the loan unless you refinance into a conventional loan. Or if you put 10% down up front, and then after 11 years, it'll automatically come off. Those are the only two ways typically to get the MI removed from an FHA loan. So as you can see, both have their advantages and disadvantages. And honestly, mortgage insurance, it's never fun to have to pay it. However, if it gets you into a home sooner, it's good to know that down the road you can get it taken off of there, you can get it removed. And so I hope you found this information helpful today. And if you did, please feel free to share this video with someone else you know that might be interested in this. Or if you have additional questions, concerns around mortgage insurance, possibly getting your mortgage insurance removed, or if you wanted to look into a refinance to get it removed, feel free to reach out, give us a call, text us. We are always here to answer your questions, always here to help. We look forward to hearing from you soon. You have a great day. Bye-bye.